All right, good afternoon, everybody. My name is Anthony Volin. I am the owner and broker of The Collective, and we're super happy to have you guys here. This is our multifamily meetup. We have education that is curated especially for multifamily owners throughout the Los Angeles area. We put on events and webinars at least every month. Hopefully we'll be able to do some in person sometime soon, but we have a huge library of information from the past that you guys are welcome to look at. If you go onto our YouTube page, just search The Collective Realty on YouTube, and we have a multifamily playlist with all kinds of really, really great speakers and sessions that we've done in the past. So we are recording today as well, in case you want to go back and take a look. If you missed anything, we have a really great speaker, and we're super happy to have you. Again, I'm Anthony Volin, the owner and broker of The Collective, and our mission really is to help you all build wealth. That's what we're passionate about, and that's what we focus on here. We have an amazing commercial director, Will Tiao, who really works hard on making sure that we have great speakers presented for you at each of our sessions. And today's I'm excited to listen to, because it's an important topic that a lot of us put on the side burners for a while and don't think about, but it's something that we need to be aware of right away. So if anyone has any questions, just raise your hand anytime, unmute yourself, and ask away. Welcome to keep your cameras on. We'd love to see your faces. Sometimes when, you're doing Zoom meetings and you're talking and you just see black boxes, it's a little weird. It's not as exciting. So if you can, keep your cameras on. If not, it's no problem as well. And I'm going to turn it over to Will Tiao, our commercial director, to take it over and get things started. Will.
Thanks, Anthony. Yes, welcome to this month's meeting of the LA Multifamily Meetup. I see some familiar faces. I see some new faces. We've been trying lately with, to make it as kind of like as if we're in person as much as possible. So what we've been doing is we've been asking everybody to come in and just introduce a little bit about yourself, give everybody about 30, 45 seconds. I'll start just as an example, and then we'll ask everybody to kind of do it, and I'll call you out as you are on my Zoom screen. So my name is Will Tiao. I am a broker associate with The Collective Realty. I am the director of the commercial real estate division there. I am primarily focused on multifamily sales. And I also have a property management company called Tiao Properties. We manage several hundred units throughout Los Angeles, West Hollywood, and the greater LA area. And I'm also an investor, developer myself, and a landlord. And part of the reason we started this was because I myself want to know more information about the multifamily market and the business, and also for us all to share information on off-market deals. I found deals here. People have found deals and made deals in this room. So I'm hoping that all of you can participate. And I'm really looking forward to our speaker today, Jacqueline Yu. But I'll start off asking everybody else just to do a quick introduction. Robert, quickly, you are up next.
Hi, yeah, my name's Robert. I work in finance accounting for like a small holding company. It's located in Santa Monica, and I'm interested in real estate. I did it. I'm a part of this group, just like a small LLC, and we own some property. And I was just I'm from the Bay Area originally, so I moved down here, so it's up there. So I was just interested in possibility in the future. Just getting a better understanding of the current market and where it's headed and things like that.
Very good. Well, welcome and thank you for joining us.
Great, thank you.
Valerie.
Thanks, Will. Hi, everyone. I'm Valerie Lee. I am a real estate lawyer. I'm non-practicing right now, but I'm dipping my toes into real estate investing, and really happy to meet everybody here. If you have any real estate legal questions you ever want to discuss, feel free to hit me up. Good to meet you all.
And Valerie's also, I should mention, a former client.
I'm very satisfied former client. Yeah.
Thank you. Paul Glass. Could you unmute yourself, Paul?
Wait 1 second here.
Oh,
Can you-
we can hear you now. We can hear you now.
Oh, okay. I'm an estate planning attorney by background, although that was my prior life. I've been in the life insurance business for a few decades and do a lot of work with real estate people. It's a real specialty. And I was invited to join in by Jacqueline.
Very good.
Thank you.
Well, thank you for joining us. Next up on my screen is Jonathan Taylor.
Hey guys, I'm an investor as well, but I'm also a mortgage broker specializing in investment property financing. So anything from small fix and flips all the way up to 40-unit commercial buildings, mixed use, ground up construction, but not right now. And this is my second time in the meeting. I enjoyed the last one, so I thought I'd drop in again here. So if you guys have any investment questions or any financing question, which is basically a third of any deal, shoot them here. Happy to answer any of them.
Thank you. Thanks, Jonathan. Thanks for joining us again.
Yeah, anytime.
Ellen Chu.
Hi, my name is Ellen, and I'm a happy client of Will Tiao. I'm a trustee of a family trust in Los Angeles. So I'm currently managing a rental property right now. So, I'd like to learn more from Jacqueline about trust today. Thank you.
And Ellen's joining us from the Bay Area, so thank you. Thank you for coming all the way.
Thank you, Will.
Next up on my screen is Joseph Choi.
Thank you for inviting me. I appreciate it. I'm in the car, but I just want to introduce myself. I'm a financial advisor with Capstone Partners Financial. We're in Newport Beach. What we do here is capital gain tax bypass trust. So I'd like to learn more about it today with Jacqueline Yu. Thank you.
Thank you, Joseph. Thanks for coming. Next, Susan Applegate.
Hey, I'm a two-time client of Will's as a realtor, and he currently manages my property. I've purchased two properties and looking to get a third in 2024, maybe.
Yes, I use Susan a lot as an example of what you can do with a 1031.
I've done a 1031. It worked out well, and I'm about to do some estate planning. I have a teenager that I need to take care of, so I'm very interested to hear about that.
Very good. Thank you, Susan. Good to see you. Next on my screen is Rich Flegg.
Oh, hi. I'm just an interested person learning, trying to learn as much as I can. I'm doing a 1031 right now, so I'm interested in the future of 1031s. I hear is kind of in jeopardy, and so just wherever it goes, it'll be interesting. Thanks.
It will. Thank you for joining us, Rich. Appreciate it, and good luck with the 1031.
Well, thanks. Almost over.
Very good. Good luck. I see Chung Ha Cha is next.
Hello, greetings from Seoul, Korea.
Wow.
I run a small nonprofit research firm called Reimagining Cities. We're working with developers, real estate developers in Asia on decarbonizing the built environment in both existing portfolios and new construction. I like new construction because we can develop multi-billion-dollar kind of lighthouse projects to showcase that sustainability and profitability can be achieved. And we have a Resilient Cities Council of the ULI Asia Pacific that I'm co-chairing. So we'll have a lot of meetings and executive learning series on this topic going forward. Thank you. I'm just here to kind of learn. Thank you.
Thank you. Thank you for joining us from Korea. We appreciate it. Connie Duong.
Hey, hi, how are you? I've known Jackie for years, so she invited me. Yeah, I'm actually a loan officer at Pacific Premier Bank. I mainly do ground up construction and some commercial real estate. So if anybody has any questions about construction loans or commercial real estate loans, yeah, feel free to hit me up.
Thank you, Connie. Thanks for joining us.
Thanks.
Huang, I believe you're next.
Hi, I've been here for a few times. Bay Area resident. I am investor. So basically, I am in the structure now with estate planning, and I'm struggling with that. So by this chance, I would like to learn a little bit more about what can be in estate planning. Nice to be here.
Nice to meet you. Thanks for joining us. I don't know if I'm pronouncing this right. Mesa or Misa? Fosette? You're unmuted, but we can't hear you. Okay, we'll come back to you. Hopefully we'll be able to hear you next. Sandy Coxis.
Hi, Will. Hi, everyone. My name is Sandy Kosis, and I am a real estate agent in Orange County. And I sold one of Will's listings to one of my investors years ago. And I was so impressed with his knowledge and expertise with investment properties that I've stayed in touch, and I really enjoy these meetups, and I learned so much. And next time I will show my face. I've just been on the beach playing volleyball all day and I'm not dressed appropriately.
No worries, Sandy's. You're in Orange County. What else do you expect?
Exactly. Corona Del Mar, and it was beautiful today. So
nice. Well, it's good to see you again. Thanks for joining.
Yes, you too. Sure.
Betsy Hall.
Hi, Will. Hi, Anthony. Hi, group. I'm reporting in from Oxnard, and just been through some estate planning, getting ready to do another round of it, and purchased property and did the estate planning thanks to help from Will and his team. So just here to take notes and gather information. Enjoy the fellowship of everybody here.
Thank you, Betsy. It's good to see you, as always. Mesa's having some audio difficulty. She says she's a realtor, which is great. As you can see, a lot of the folks on here are real estate professionals or some type of financial professional. So that's always we always love to see that. It's always great to have a group like this. Brian.
Yeah.
Brian, are you there? Oh, sorry. Hi, everybody. Sorry, I can't use my microphone or camera at the moment. I'm in real estate. Okay, good to know. And we have one last person joining, and we're going to surprise him. Hey, Chris Crosby. We're just doing introductions right now. If you don't mind introducing yourself, just telling us a little bit about yourself, if you don't mind. Okay, maybe
maybe later.
He just dropped off. Maybe he doesn't want to. Oh, there he is. Well, for those who weren't able to introduce themselves now, maybe we'll be able to get to you guys later. So we always start off the session with just a quick update of where things are at in the multifamily business. I think we all know that the single family market, right, is just crazy on fire like you wouldn't believe. I'll give you an example. We had a listing for a 2-bedroom, 2-bath house with an unpermitted ADU in Toluca Woods near Toluca Lake in North Hollywood. 2-bedroom, 2-bath, 1,372 square feet, so not even 1,400 square feet. I listed it for $995. I got 15 offers. We closed with an all cash, non-contingent deal, $263,000 over asking. So that's where the single family market is right now. And everybody hears about that in the press, how tough it is. And I can confirm that because it's true. It's like, I feel for buyer's agents right now and buyers, generally speaking, just because there is so little inventory right now on the single family side. However, on the multifamily side, things are a little bit different. We're seeing cap rates have held steady for the most part throughout the pandemic. Surprisingly, I think a lot of people expected cap rates to go up. And for those of you who have been in our session before and know how cap rates work, right? The higher the cap rate, the better the return. Similarly, for gross rent multipliers, the lower the GRM, the better the deal. So GRMs and cap rates have held steady roughly through the pandemic, and are starting to probably slightly dip even. That said, one thing I have noticed is that people are definitely not overpaying for multifamily. People are being very, very cautious. Buyers are being very cautious when it comes to purchasing, and they're really running their numbers. They're asking a lot of questions, particularly if there's been any COVID back rent that hasn't been paid during this period. They are, like I said, cap rates are very, very much holding steady. There's a lot of people considering selling. And the reason for that, I would say primarily is they find the regulatory environment in California very challenging. As we all know, this is a very tenant-friendly state. And during this period, most of us know there's been an eviction moratorium. And frankly, that's really hurt a lot of mom and pop investors. I'm speaking to someone right now who has a single family house in Silver Lake, and they moved to Australia and their tenants have not paid for 14 months. They are 100K behind in their rent. And they find themselves in a position where they're worried they're not going to be able to hang on to the house. And so these are situations that a number of multifamily owners find themselves in. So people are considering selling. That said, throughout the pandemic, at least on our books from the property management side, we have found that the majority of tenants are paying. Even at the bottom point of the pandemic, we had 90% of our tenants paying. Now we're at 90%. I don't know how I got muted there.
I did, I'm sorry. I'm sorry.
That's okay. So we're seeing about 98%, which is where we were pre-pandemic. So I know that most property management companies I'm speaking to are collecting between 90 to 95%. So I think that's the reason that cap rates have held steady, is because still, generally speaking, people are paying rent. And we're starting to see now with the opening up of the economy, vacancies are starting to get filled again. For a while, we were starting to see vacancy rates creep up. Definitely, as we've talked about in the past in this room, we've talked about how A-class luxury housing has taken a real hit during the pandemic. B-class, a little bit less so. C-class, even less so. But now we're starting to see those things fill up again. And people are coming back, people are starting to rent, and we're starting to see rent prices stabilize. Whereas they had been falling before, they are now stabilizing. So, so that's what we're seeing in the multifamily market. I've had a number of folks ask us, we've discussed in this room a lot about tenant in common conversions. because that's definitely a trend with the multifamily business industry here in Los Angeles, is to convert apartment buildings into tenants in common. Many of you have been following our what's been going on with our building in West Hollywood called the Hayworth. This building was an 8-unit multifamily property. Was purchased in the fall of 2019, and the principal group then remodeled all the units and sold each of the individual units as tenants in common. All suites have now been sold. We closed out last week, and the average sale price was $815,000 per unit, which, if you know your numbers in this area, blows away anything you see on the multifamily side. Anything, there's not even close to that number in terms of an exit price, in terms of sale. So because of that, we're getting a lot of calls about tenants in common. We've done a number of seminars on tenants in common. It's not for every building. It's not for every area, but for the right one, it can be a really interesting strategy. Like I said, we're getting a lot of folks calling us about converting their apartment buildings into tenants in common. And like I said, it's just not for everyone. It really has to feel like a home, like a condo, in order for it to make sense. So, but if any of you have any questions on tenants in common, happy to take those questions. And before we get into Jacqueline's presentation, I always like to give everybody an option to talk about their needs and wants. I will tell you that I have 2 listings coming to the market soon. I have a duplex in Silver Lake. One's a 3-bedroom, 2-bath, and the other's a 2-bedroom, 2-bath. Neither is under LA rent control. It's a hillside property. They're both currently rented. It would be a very interesting TIC for someone. So we're going to list it at 1.5. So if anybody has any interest in that one, I'm happy to discuss. I also have an 8-unit multifamily coming up in the Pico Union area near downtown, just on the other side of the 110, near the Staples Center. That'll be 7 one-bedrooms and 1 2-bedroom. I don't know the pricing on that yet. I'm still in negotiations with the seller on that. Some of you, if you remember in the last session, I had a 10-unit in East Hollywood that was 8 one-bedrooms and 2 2-bedrooms. That's now in escrow. Like I said, people are just, they're not overpaying. People are really running their numbers, and they're making sure that their GRMs and their cap rates are solid. So let's open the floor to questions or to needs and wants. If you have a deal that you want to present to the group, or you have a deal that you're looking for yourself or for a client, now is the time. And I'll ask Chris Crosby to go first.
Starting off on the topic of questions, you had mentioned, some owners having issues with rent collections. Do you have any anecdotal, experience or, background on the California Rental Assistance Program? Those owners that haven't been able to collect rent, have any of your clients, people you've met, been able to apply and get those funds?
So yes, I do. Being a property management company, we have several tenants who are behind. I have one tenant who's 6 months behind on his rent. He owes over $30K. So in his case, the landlord applied for funds from the California assistance, and the initial application said that the state would pay for 80% of the back due rent if they would be willing to forgive 20%. So they applied for that. They agreed to the 20%. It took a while for the tenant to then apply. But I think they eventually did. We still have not received funds.
And then
No.
Newsom just extended that to 100% just recently, right?
No, he has proposed bringing it up to 100%, but that has not been approved yet. Okay. And on top of that, the funds that have been allocated so far, nothing's been spent. So in the meantime, landlords are continuing to pay their mortgages, continuing to pay their expenses, but like there's still nothing so far that has been distributed. The only distribution that I'm aware of is there was one by the city of LA for like $1,000, and that was for a maximum of 2 months, so a maximum of $2,000. And landlords had to agree that they wouldn't pursue an eviction during that time. So that's the only monies that I'm aware of that has been distributed at this point.
Awesome. I appreciate you sharing that.
Of course.
Going into needs and wants, I'm looking to invest in a multifamily, ideally Long Beach or Inglewood. Looking at either a 3 or 4 unit under 1.2 or a 5 to 7 under 1.7. So if anyone's aware of any off-market deals, I'd definitely be interested in taking a look.
Sounds good. Thank you, Chris.
Chris, I have a 3-unit coming up in West Hollywood, but it's probably going to be 1.6, but they'll all be vacant. So if you're interested,
Okay. Awesome. Thank you.
I saw a question in the chat. Jonathan Taylor to everyone. Who lends on TICs? I have not been able to fund these deals due to the ownership structure. It's an interesting question, Jonathan. So are you talking, Jonathan, are you here with us?
Yeah, I'm right here.
Okay, great. So are you talking about the investor who's buying it, or are you talking about the individual owners buying the individual units?
Well, this year, a lot of my clients, like if we have existing clients, I can do conventional loans. The licensing is the same.
Sure.
And so when I went by some of our hotel lenders, they would not lend on tenant in commons because it's an ownership share, not an actual vested real property asset. And so I spent a good few days, and this is kind of outside my wheelhouse. I work more on the investor side. Like an investor, they can see the value in it. They can see it, then we can do investment, no doc lending. But for conventional full doc financing, I haven't been able to find anyone. So for any of your clients who occupied the property to live in, I just mostly just so I can research it a little bit, because it's always, I think this is something that's going to happen and I'll get more calls. So if anybody can shed some light on it, I'd appreciate it.
Absolutely, absolutely. So we're aware of 3 lenders that do TIC financing. Kind of the big kahuna is Sterling Bank. They can do as little as 10% down. I'll be honest though, I have not had a good experience working with Sterling Bank. So the second bank that we've been working with is National Cooperative Bank, NCB. They were the ones who funded. We had 4 of the 8 units at the Hayworth that I just showed earlier. 4 of them were financed by NCB. The issue though for NCB is that they require 25% down, at least in Los Angeles. In the Bay Area, they'll go as low as 20%. So it's a little bit higher. And generally speaking, with TIC lending, it's a little bit trickier. Obviously, it's not conventional financing, like you said, because there's no underlying asset that they're lending against, right? Because the owner has a share of the whole property. So most lenders won't touch it, right? Except for these few lenders. And so to compensate for their risk, they generally say that there's no, so usually it's about a half point to a point higher. Both NCB and Sterling, neither of them offer a 30-year fixed product. It's only ARM products. So
like a 5-1 to start off.
Could be a 5-1, could be a 3-1, could be a 7-1, could be a 10-1. Okay. So that's with those 2 lenders. My understanding is there's now a 3rd lender that has jumped to the game. It's a San Diego-based lender. I don't know who they are. I'm working with the broker, the loan broker, who did the deal. He told me that this 3rd lender is open to doing a 30-year fixed product. However, there's a catch, as there always is. First of all, the rates are high. They're like, I think he said 4.6 was the rate. Okay, so we're talking like almost 2 points above what conventional is, right? So that's number one. Number two, it costs you 2 points. Okay, so it's not cheap money. That said, some people might prefer a 30-year fixed product. The other thing that this bank does, what I've been told, unlike NCB or Sterling, NCB or Sterling will not finance a TIC purchase less than 600 square feet.
Interesting. Okay.
But this bank will. Okay. And obviously there are studios and 1-bedrooms that could qualify for this. So that's something to consider. Okay. Now, for those of you who have been in this room before and know, we've talked about TICs. The way people compensate for TICs is that they're usually priced about 10 to 15% below market. Okay. Those units I sold at the Hayworth, if those were pure condos, I guarantee you those would have gone for 900 to $1 million plus. But because it was a TIC, we priced them in the mid 7s.
Gotcha.
Okay.
Perfect. Thank you.
Thank you. Riley Nielsen, I have a want. I'm a bit late to the party though. We don't mind late party comers.
Awesome.
Riley, introduce yourself, please.
Yeah, my name is Riley Nielsen. I'm a multifamily investor in Phoenix. I invest internationally, but mostly in the lower 48. I just closed on a 54-unit complex in Arkansas, and I had a couple private equity funds that had an interest in investing with me. But the total equity raise for the project was $1 million, and their minimum placement was $5 million. So right now I'm looking for 250 plus units, or at least a project or portfolio that can take a $5 to $10 million placement.
Very good. Thank you. Anybody?
Yeah, I kind of need to place the money quickly because I'm also oversubscribed on this last deal.
Got it.
So that's my want, so to speak, is just to find a place to put the money.
Understood. And I'm definitely hearing that. Obviously, there's a lot of capital out there looking to be placed.
Yeah,
So, we're hearing that as well. But like I said, at least in Southern California, we're not seeing stuff being oversubscribed or like people are being very cautious, I think, once again, because of the regulatory environment.
Okay. Well, we do Class C value adds in tertiary markets. We're open to a lot of other things as well, but the product that we look for sometimes is passed over by investors of this kind of size. Usually they want primary markets and they'll do Class B or A. That kind of makes us a little bit different and able to pick up deals that may not otherwise be.
Okay.
Cool. Thanks.
Sounds good. Thank you, Riley. Is there anyone else that has a need, deal, or want before we go to our speaker, Jonathan?
Yeah, I'm looking for 5 to 20 unit off market multifamilies in Los Angeles. So substantial value add, not looking for turnkey.
Okay. Very good. Anyone else? All right. It's my pleasure to introduce our speaker today. Jacqueline Yu specializes in advanced estate planning, business succession planning, and trust administration involving both domestic and international matters. Her main objective is to help families settle their financial and personal affairs to ensure that their loved ones are cared for and protected, and to preserve and grow the family wealth for the next generations. She holds a Juris Doctorate degree from Notre Dame Law School of Law and a Master's of Law degree from UCLA School of Law, Tax and Business Law Specialization. She has a Bachelor of Arts from UCLA in Political Science, International Relations, and Ethnic Studies. She is a dear friend of mine and a fantastic estate planning lawyer. So I'm very, very honored and excited to introduce my friend, Jacqueline Yu.
Thank you so much, Will and Anthony, for inviting me to present today. And thank you everyone for joining today's meetup. I'm gonna go and just share my slides real quick. Let me know if there's any issues, if you can't see the slide, but I think it is showing now to everybody. And so first and foremost, just some housekeeping. I'll be going over 4 main points during the presentation, and then afterwards we'll leave some time for Q&A. And for the presentation, these 4 main points are, number 1, what are the changes in California's property tax rules under Proposition 19 that became effective on February 16th of this year? Number 2, what are some of the key anticipated changes in federal income, gift, and estate tax rules under President Biden's tax plan? Number 3, what are some of the tax and advanced estate planning strategies you can implement this year before these federal tax law changes go into effect to minimize your tax exposure, but also transferring these interests to the next generation? And number 4, some special rules that apply specifically for foreign persons who own real estate in the US. And so to start off with, I wanted to just share with you a little bit of an anecdote, a story of one of my clients. An elderly woman approached me and reached out to me a few months ago in March, so after Proposition 19 came into effect, distraught because obviously there was very little notice for her and for a lot of us to make transfers of real estate prior to the February 16th deadline. And her husband passed away a couple of years ago. She inherited all of her husband's assets. So when you combine that with her assets altogether, it's about 20 million. And a lot of these assets are in real estate holdings, real estate investments. She also has 2 adult children, one who is married, he has a child, so she has 1 grandchild. The second child, we'll call child number 2, is in a long-term relationship, likely to get married in a couple of years. So some of her concerns obviously are the property tax reassessments that would be incurred on her death when she transfers these assets to her children, and whether her children would have sufficient funds to pay the increased property taxes. Number 2, the estate tax consequences that would be incurred when she transfers these assets in light of President Biden's tax plan of reducing the estate and gift tax exemption. And if not, it is guaranteed that the current 11.7 million exemption that we're all afforded this year will sunset in 2026. And if we take into account Bernie Sanders' 99.9% Act, which would even further lower the exemption to 3.5 million, a lot of people, especially in California, who own real estate will be affected by this significant reduction in exemption. The other concern she had was also to make sure that these assets are protected and preserved for her children, her grandchildren, and more remote descendants, protected from divorces, from lawsuits, and creditors' claims. So a lot of us can identify with these issues in our own personal circumstances, and these concerns are very well founded because, for instance, under California's Proposition 19, it effectively eliminated a parent's ability to leave to their children or grandchildren their property tax base in their primary residence and real estate investments without reassessment. And now nearly all property will be reassessed at its current fair market value with one very small exception, and that is if you transfer a principal residence to your child, so long as your child uses that residence within 1 year of the transfer as his or her principal residence, and the property is worth less than the total property's base year value plus $1 million. And that's highly impractical, especially in California and Los Angeles, where the average home value would far exceed the $1 million mark. And for adult children who are inheriting and they have their own families, it is unlikely that they'd want to move back into their parents' home. And the other concern that we have is on the federal tax side, and that is President Biden's tax plan and the anticipated changes that will likely go into effect sometime next year and may even be retroactively applied to January 1st, 2022. And some of these key changes are increasing the top ordinary income tax rate for taxable incomes above 400,000 from 37% to 39.6%. The tax on capital gains and qualified dividends at ordinary income tax rate for income above $1 million, and that rate would increase to 39.6%. The elimination of the basis step up on death for inherited property, and the probable capital gains tax realization on transfer of these assets on death. The reduction on the 11.7 million exemption, as I mentioned, to even as low as 3.5 million, and the elimination of 1031 exchanges for income earners above 400,000. And someone mentioned this concern and would apply to income earners of above 400,000. So let's first tackle the property tax issue for this client. First and foremost, Proposition 19 does not apply to legal entities that own real estate. It only applies to real estate that is directly owned by the transferor. So to the extent that real estate is owned by a legal entity such as a limited liability company, a partnership, or a corporation, Proposition 19 does not apply. And there are two main rules that I hope that you can take away from today's presentation. And number one is there is no reassessment for transfers of 50% interest or less of an ownership in a legal entity. And number two, there is no reassessment for transfers of real property into a legal entity so long as the ownership interest is identical before and after the transfer. So how can we use these rules to our advantage? Well, back to the example for my client, even though these transfers would occur after Proposition 19 is now into effect, Proposition 19 won't apply. So my client, the parent, can transfer 100% of her real estate into a legal entity. Let's just use an LLC. That transfer into an LLC will, as long as she's 100% sole member of that LLC, will not trigger a reassessment because the ownership interests are identical. Step two, she can transfer 50% of that interest to child number one without triggering a reassessment, because again, it's 50% or less of the ownership in the legal entity. Then let's fast forward a year later. Parent and child number one can remove their property from LLC number one and transfer it into a new LLC. Let's call it LLC number two. From LLC number two, the parent can then transfer her remaining 50% interest to child number two, again, avoiding reassessment. Now, the end result will be child one and two will be owning 100% of the LLC, avoiding reassessment completely. But again, these would take several steps, and it would take a year in between to be able to execute these transactions to avoid any type of concerns of step transaction where everything would be deemed as if merged into one step. So again, there are ways of avoiding reassessment by taking into account these transactions and planning ahead of time. Now let's go to the second issue that my client had, and that is how to deal with President Biden's tax plan and to preserve the assets for her children and grandchildren and descendants. Well, right now we have this window of opportunity of maximizing our current high exemption amount of 11.7 million. IRS regulations had already issued confirming that as long there is no clawback when you use the 11.7 million exemption. So if you've given away 11.7 million today and the estate tax exemption is reduced to, let's say, 6 million in the future, IRS won't come back and after you now auditing your gifts because you've exceeded the that exemption amount, the 6 million exemption amount. So again, there is no clawback. So you have this window opportunity to use what you have, or you will lose it in the future once the exemption is reduced. The other opportunity that we have is to maximize the use of transfers of fractional interests in legal entities and taking advantage of the valuation discounts you can use to value these gifts of legal interest to your children so that you can utilize more of that estate and gift tax exemption. So if 50% of the LLC is without discounts is worth $1 million, but with discounts, let's say 30%, for gift tax purposes, it would be worth, let's say, $700,000. And so again, you have an additional $300,000 to use of an exemption for additional gifts. Now, how about protecting these assets for the benefit of your children and grandchildren so that they are not exposed to creditors' claims, lawsuits, and divorces? So instead of gifting these LLC interests outright, you can gift them through what I call irrevocable legacy trusts. And this is just more of a visualization of what these trusts are. I know there's a lot here to take in, and I'd be happy to discuss them after the presentation. But essentially what these legacy trusts provide is, one, it provides asset protection for the beneficiaries, as well as the parent donor or grantor of the trust. Because once these assets are transferred into this trust, it's no longer 100% owned for creditors' purposes by the parent donor. It's also not 100% owned by the beneficiaries. The beneficiaries can continue benefiting from this trust so long as the purposes for the benefit is limited, and we call it an ascertainable standard. So distributions of income and principal from this trust needs to be limited for purposes such as health, education, maintenance, and support. And the acronym is HEMS. So as long as the terms of the trust provide a HEMS standard and the distributions are limited for these purposes, for IRS purposes, number one, these assets are not part of the beneficiary's estate. For creditors' claims purposes, these assets are not owned by the beneficiaries. So as I referenced with IRS treatment, these assets will also be excluded from the child's estate, from a grandchild's estate when it gets passed down to the next generation. So it's a way of transferring wealth with pretty much not being exposed to estate tax on several levels of intergenerational transfers. Now, I'd like to also mention, though, that there's a second level of death tax, and that is when the child dies and these assets are now transferred for the benefit of the grandchild, there is a second level of death tax called the generation skipping transfer tax. But fortunately, in addition to the 11.7 million exemption that we have from estate and gift taxes, we also have an 11.7 million generation skipping transfer tax exemption. So when the parent creates this trust, she'll file a gift tax return and she can allocate 11.7 million of her estate tax exemption. She can also allocate 11.7 million of her generation skipping transfer tax exemption. So the end result would be that on the child's death, no estate tax. On the parent's death, no estate tax. Once it passes down to the grandchild, there is no generation skipping transfer tax as well. The limitation, if we set up this trust in California, however, is that there is a rule against perpetuities in California. So this trust must terminate 90 years after it's created. But that gives us a significant number of years to pass on wealth from one generation to the next without having to incur estate and GST tax. Another option, instead of gifting these assets to the trust, we can also structure it as a sale. And that can come into play for two reasons. Number one, if the parent doesn't have enough estate and gift tax exemption to apply to the transfer, she can structure it as a sale. And so as long as this trust is what I would structure as a grantor trust, for income tax purposes, the sale to the trust would not realize any capital gains because it's deemed as if she's selling these assets to herself for income tax purposes. But for estate tax purposes, these assets transferred is it's a complete gift. So these are excluded from her estate. And it's also an opportunity for her to continue receiving some cash flow or continue to receive cash flow from these assets transferred for a certain term of years upon the sale. The sale would be structured as an installment sale. So principal payments of principal and interest on the note over a term of years of the note would then be going back to the parent. So again, there are several different variations of how we can structure this trust, whether it's a gift, a sale, or a combination of both, and also to provide a certain level of cash flow back to the parent without realizing income tax. Again, though, this structure can really be implemented before the end of the year and before the actual changes are going to go into effect under President Biden's tax plan. And if that goes into effect, what else is on the chopping block are these grantor trusts, in addition to 1031 exchanges. So it's prudent to be able to take advantage of these benefits now and not wait until later when it's too late. But what happens if we have a married couple, or if the parent can't completely part ways from the assets and would need to benefit from these assets during their lifetime? Another strategy we can use, which is a combination of what I call a marital trust and an irrevocable legacy trust, is for a married couple, they can maximize on both of their estate tax exemption and create a lifetime trust for each other. And the benefit of this is the beneficiary spouse can benefit from the asset, and the donor spouse indirectly can also benefit from the asset. The assets transferred to the trust would be excluded from the donor spouse's estate, the beneficiary spouse's estate, and on the beneficiary spouse's death, it goes down into a legacy trust for children, grandchildren, and remote descendants. And so with that, we can get the best of both worlds. You can still benefit from the assets as a donor spouse indirectly through your beneficiary spouse, and you can also exclude these assets upon your death, the beneficiary spouse's death, and your descendants. The last point I want to touch base on is the special rules for foreign persons who own real estate in the US. Unlike US citizens, green card holders who are domiciled in the US, who have this 11.7 million exemption, if you're a non-resident alien who own real estate in the US, you are only afforded a measly $60,000 exemption from estate and gift taxes. And anything above that would be taxed at a 40% estate and gift tax rate. In addition to that, if you directly own the real estate and you're now selling this piece of property, you're subject to a US tax withholding of 15% of the gross sales price, or the amount realized, which would pretty much comprise of the cash payment plus any liabilities that the purchaser assumed as a result of the transaction. So 15% US tax withholding on the gross sales price or amount realized of the sale. Unless the one exception is if you had enough time to file what we call a FERPTA withholding certificate. And so if you file this certificate with the IRS, then you can adjust with the withholding amount to 15% of the capital gains realized on the purchase as opposed to the gross sales price. Now, how do you get around this? Number one, before a foreign person purchases real estate in the US, they should first set up a structure, a double entity structure. They should set up an entity such as a US corporation. That US corporation would purchase the real estate. At no event should the foreign person directly own the real estate. And step two, this US real estate should be owned by a foreign corporation, and from which the foreign person would own shares in that foreign corporation. And in that way, the ownership interest by the foreign person is what we would call an intangible asset. So it would no longer be deemed situated in the US. So when that person dies, when that foreign person passes away, their shares in the foreign corporation would not be deemed US situs asset that would be subject to US estate and gift tax. The other benefit of this double entity structure is that FERPTA withholding rules for sales of real estate would not apply because, again, the foreign person does not directly own the real estate. It's the US entity that owns this real estate that would be the seller on the transaction. At the same time, if this real estate sale is a liquidating event, the the U.S. corporation would realize the federal income tax. However, any distributions from the U.S. corporation to the foreign corporation would be a non-taxable event. So it is definitely important when you have a foreign person or you're advising a foreign person who's looking to purchase real estate in the U.S. that they should first set up these types of structures and not own these assets directly. I know I went through a whole plethora of concepts here and strategies, and I'm more than happy to discuss this offline, and you feel free to email me. And here's my email address and contact info. Be happy to share my slides as well and other helpful materials if you'd like to. And I'll leave it open now for Q&A.
Thank you, Jacqueline. I have a lot of questions, but I'm going to open up the floor first to see if there's anyone here who has any initial questions to start off with. Can you post Jacqueline's contact info? I think your slide shut off before people got to see your contact information. So
okay, here it is. Back up.
Okay, there we go. Anyone else? Feel free to speak up. Okay, I have a few. So one thing you didn't talk about here was 1031 exchanges.
Mm-hmm.
That's obviously a big part of the multifamily investment world. There was a big article in the New York Times today about it. What are you hearing about it? And what are things investors can do to kind of hedge if there are any changes?
Sure, and again, a lot of this is just forecasting, right? And so some thoughts that I have on hedging against these changes, perhaps creating irrevocable non-grantor trusts. So for income tax purposes, the donor parent would not be treated as a grantor. So it would be a separate entity. It would be this irrevocable trust that would hold a piece of real estate. So that would be a separate taxpayer. So if the 1031 exchange is still available for income earners of 400,000 or less, then perhaps you can transfer an asset into an irrevocable non-grantor trust to qualify for those 1031 exchanges.
Understood. I have my own thoughts about this because I know there's been talk about getting rid of the 1031 exchange for years, but I have my doubts about whether it will actually change because it's actually quite a bipartisan issue. There are a lot of people on both sides of the aisle who really benefit from the 1031 exchange, but we'll see what happens.
And I agree with you. And again, this is such a huge, significant shift in the tax regime that I would expect a lot of pushback from both parties, actually. So, the best that we could do is plan for the worst and with enough time to be able to structure something before these laws go into effect.
I'm meeting next week with Adam Schiff and Maxine Waters, so I'm really curious to see their reaction and what their take is on the 1031. We're going to be talking about that and several other issues regarding housing, but that one in particular, yeah, I'm really curious to see how they react and what side they're on with that.
So, Jacqueline, say someone has several real estate assets, right? Say let's just take a classic example. You have someone who's married, has a kid or two, and say they own their primary house and a couple investment properties. Right now, they're all in their name. What's the first thing they should do?
Of course, they should put a lot of these investment properties into these LLCs now and go through the steps that I went over in trying to minimize property tax reassessment down the road. For their primary residence, it really depends, right? Because we have to be careful about how to transfer the primary residence when they're still using the residence during their lifetime. And, if the basis step up is still there and it's not going to be eliminated under President Biden's tax plan, then it may make more sense for them to hold on to this property and for the children to benefit from the basis step up, and the children can then sell the property after their death, and they could minimize or even eliminate the capital gains tax consequence. But if there is no basis step up down the road, right, and this is property that they want to make sure that it gets passed on to the next generation, then they may want to consider transferring that residence into an LLC. The thing is, though, they need to be comfortable with paying rent now that they're using the property during their lifetime, because they're no longer the owners on this asset. But the end result, the benefit is that, again, they could minimize or avoid the property tax reassessment, and they could also avoid the estate tax consequence when the assets are transferred.
Sure. Can you give us an example of a, hate to use this word, like a horror story that you've had to deal with one of your clients who maybe didn't do their estate planning in a way that you would have suggested if you had been involved earlier?
Sure. I think the worst horror story is someone who had no trust whatsoever. So I don't enjoy doing probate. And so if dealing with probate and the administration of an estate, dealing with real estate on top of that, and then the estate tax consequences, so it's a taxable estate, I think that was the worst horror story that I can share, in that, you know, you're dealing with multiple issues when somebody passes away: a probate administration, an estate tax without liquidity, and children who are obviously stressing out with inheriting all these assets and the tax consequences, the estate tax consequences. But the one benefit from, or the silver lining from that case, was that, you know, the basis step up is still there. And so at least the children were able to create liquidity in the parents' estate by selling the assets to pay the estate tax.
Are you seeing major changes or people coming to you a lot more due to the passage of Proposition 19 last year?
You know, I did in the beginning of the year, even when it just got passed in November and would go into effect in February. People really didn't start acting until the first of the year, or even a few weeks after the first of the year. And then at that point, that only left me about less than a month to make transfers of real estate before the February 16th deadline.
So what were people doing? What were they doing to hedge, or what were some of the strategies that you were using at that time?
Sure. So at that time, we still had the reassessment exclusion to use, right? So we could transfer the primary residence to the child free of property tax. And we can transfer certain real estate investment up to the $1 million exclusion for secondary properties. And so once it's transferred to the child, then we don't have to go through the several steps that I mentioned of transferring it to an LLC, transferring it out to an LLC, and then, you know, it saved us a lot of time because of the reassessment exclusions that were available. So what I did was, for one case, you know, I transferred the properties from the parent to the two children outright because of the reassessment exclusion, and each child had a legacy trust, and those legacy trusts created an LLC to hold that property. So in that way, we don't have to do any additional steps down the road. And if we're looking at President Biden's tax plan of a capital gains tax realization on transfers on death, or even lifetime transfers, we wouldn't have been able to make these transfers if that went into effect, because now we're also dealing with capital gains tax.
Right. So what are you finding people are more concerned about, the capital gain side or the property tax reassessment side? Or both?
You know, if we're looking at a 39.6% capital gains tax rate, which is close to a 40% estate tax rate, hands down, capital gains tax, estate tax wins. Property tax reassessment, yes, over time, they're going to have to pay more. But, you know, again, as I mentioned, there are ways to try to minimize that.
Understood. Anyone else have any questions? Anthony?
No, that was a really, really great presentation. Thank you so much.
You're very welcome. And again, I'm available to answer any questions. Feel free to email me, and look forward to speaking to any one of you one-on-one.
I see a hand up. Kwang, did you have a question?
Yeah, correct. I have a question. Okay, for example, I have 5 properties. And so if I understand you correctly, I would need to have 5 LLCs. Is this correct?
No, ideally, yes, because for asset protection, it's you are insulating exposure of the asset in that LLC by creating separate LLCs for each asset. So if there was a tenant that sued you under one LLC, as long as there's only one property in that LLC, they would not be able to go after your other properties because they're separate entities.
Yeah, I understand that point. The problem is in California, they ask you for $800 franchise tax per LLC every year, whether you are doing business or not. So,
Right.
So you have 5 LLCs, you are paying about $4,000 per year.
Right, right. So
which is big money.
It is, and it's a cost-benefit analysis. But at the end of the day, the risk of you getting sued and them going after, a significant portion of your assets, it may be worthwhile to pay that $800 a year. Another way of kind of minimizing that risk is just making sure you have enough liability insurance, umbrella insurance to cover these types of lawsuits if you don't want to create separate LLCs for each asset.
Yeah.
So what do you think about the series LLC structure? What do you think about that?
Right, and that can be done in jurisdictions like Delaware, and here in California, don't have that same benefit. But just know that, it does provide you that asset protection. The misconception is that people think by creating these Delaware series LLCs, they're also avoiding California tax. No, because as long as the real estate is in California, you're still subject to California tax. It can provide a certain level of asset protection through these series LLCs. But you'd have to go outside of California to form these entities.
Got it. Thank you.
It really is, Kwang. I mean, I have a lot of investors who ask me the same question, right? About, do I need to set up a separate LLC for each building? And I give them the exact same answer that Jacqueline just said. It is really your decision. A lot of them don't. A lot of them may hold 2 or 3 buildings in a single LLC. I always just tell them there is, possibility that if you have a problem at one of the properties, they can cross collateralize and try to, sue you for all the properties. That's your decision. That said, I think Jacqueline also makes an excellent point about umbrella and liability insurance. Those are much less, right, than $800 a year. You can get very good liability insurance and umbrella insurance for much, much less than $800 a year. So that's something worth discussing with your insurance broker. It's something, I have because you can get like 5 million, 10 million, in liability insurance, umbrella liability insurance for very, very cheap.
Yeah, I got it. Thank you so much. I got the point.
Okay, thank you. Is there anyone else who wants to say anything or have any other questions? Or any last minute wants, deals, or needs that anybody wants to throw out there? All right. Yes.
Just the last question. Are you going to share the presentation that you just talked about that? Very, very good presentation. Yeah.
So let me just type in, because I know I stopped sharing, but let me just type in my email, and feel free to email me if you'd like me to share the PowerPoint, and be happy to answer any other questions you have.
Yeah, give me a second.
And we can share the presentation with everybody who's on here. As long as, if you registered, we should have your email, and we can send it out to you along with a link to the video of this meetup. Thank you, Jacqueline. Thank you so much for your time.
My pleasure.
Great job.
We really, really appreciate it. Learned a lot as always, whenever you speak. So thank you.
Well, thank you very much as well.
And Anthony,
Thank you, everybody.
I'll let you close it out.
All right, everybody, I guess we're done for this session. We look forward to seeing you next time. Our events are always posted at thecollectiverealty.com in our events tab. If you are in LA, everything's going to be reopening coming next week, and we're having a little party in West Hollywood. Our office is in the middle of West Hollywood, so it's Pride Month, and that weekend there's a lot of Pride celebrations. So we're using it as also an excuse to invite people into our office and just reopen our office to everyone. So if you want to stop by for a drink, we'll have a DJ. We'd love to have you. We're at 8278 and a half Santa Monica Boulevard. It'd be a great way to connect face-to-face and do some networking and have a nice afternoon. So it'll be Saturday from 2 to 5. I'll type it in the chat, but if anyone has anything else they'd like to say or bring up, welcome to, or add it in the chat. Otherwise, find us next time, and make sure you check out our YouTube channel. All you need to do is search The Collective Realty, and we have a lot of really great information there. And this video will be up there tomorrow. So have a great week, everybody. Thank you so much.
Thanks, everybody.
Hey, Anthony.
Yes.
This is Cha from Korea.
Hi, so glad to have you.
Yeah, do you work with Will?
Yes.
I see. And do you guys, I sent you a PDF file on a carbon neutral mixed use development. We're helping to shape the design strategy, everything about mixed use communities, resilience and healthy and all that kind of stuff. But what we like to do is layer on a carbon neutral roadmap in addition.
I'm just looking through your PDF right now. It looks amazing. Wow. This is huge.
Yeah, the UN is forecasting that 50%, over 50% of global construction occurs in Asia, and we are polluting the world pretty bad. So what we're trying to do is get these lighthouse projects in different pockets of the world. And if people are interested in that kind of, I guess you could call it impact investing or net zero investing. So we'd love to share how.
What is your role with there?
Well, in this one, I might become the co-developer of the Innovation Campus piece, which is roughly 1 million square feet of land of the larger development. I'm also advising on a project near Toronto, which is a $6 billion mixed-use development as a sustainability advisor. So I do that since 2018.
And how do people invest? What's like the entry level to invest?
Entry level, I didn't.
Or what's common? What's common? What are you looking for? What would be a great person to connect you with?
Real estate developers that are embracing carbon neutrality on top of what they usually do.
And they could be in the US?
Projects could be in the US. We're trying to link some of the real estate players in the US to opportunities in Asia. So either at Korea, I advise the Penang government. So there are different projects throughout Asia that we could potentially work on. But the location of the project doesn't really matter. I just wanted to take deep dives as to real projects. What's the process to drive down carbon emissions from large mixed developments and create it as a lighthouse project, not to drag down investment returns. So we kind of link it to the ours.
I mean, it sounds like this would be a great presentation for a city who's looking to maybe maybe even more specific, like a planning commission of the city, so they understand what this options are that's happening, what's working, what's not, connecting developers to you, maybe something like that, right? Like on a bigger scale.
Well, I've worked with, I do work with cities. I collaborate with the Smart Cities Council based in Washington, D.C. But cities, they don't really, well, cities do a lot with respect to smart, sustainable cities, all that thing about that. But I think my preference is to work with the real estate developers because they are making the business decisions, the money decisions as to how to design, build, and operate their developments. If it's housing where you build and sell, I'm not really interested in that because you're not operating it, so you have a little bit less concern over what the operating expenses would be. I know in California you have the net zero laws that maybe all residential units have to be net zero energy. But the biggest problem is linking leaders like Kilroy or some of these leading real estate companies that embrace carbon neutrality to opportunities in Asia, because in Asia we have a big problem. We have a lot of big real estate developers building really fast, and we do it very unhealthily, energy hogs, spewing out greenhouse gases and pollution.
Yeah.
Yeah, so that's the main target, I think.
Okay.
So there's this Net Zero Asset Owners Alliance. It's a group of like pension funds, maybe 30-40 trillion dollars of assets under management, and they are trying to make an impact to work with developers to look at low carbon developments, right?
Yeah.
So the thing up in Canada, it's called Lakeview Village, and we're looking at, can this development be carbon neutral by 2040? The master plan was approved last year. We're going to start building first phase. That first phase will not be carbon neutral, right? We will supply it with gas heating, but how do you gravitate this so that the entire community of, say, 25,000 people, this community will be carbon neutral by 2040? And right now we're trying to do calculations as to whether that's practical and is it real, right?
No, that's great. I'm going to look through your PDF a little bit more as well. And
okay,
thank you so much for sharing that.
Yeah. Well, we gotta, fight this thing called climate change.
Yeah.
And no one really knows. So what am I supposed to do, right? And through the ULI, especially in Asia Pacific, I'm co-chairing the Resilient Cities Council, where we are looking at, okay, what do we do over the next 12 months to make a difference? So things are getting a little bit serious around this agenda of greenhouse gases.
Yeah, absolutely.
Yeah.
All right. Well,
Thank you for connecting, and really enjoyed your session. Again, Jacqueline's really good. She's very knowledgeable.
Very smart, yes. Come back anytime. We always give an opportunity for anyone who's present to tell everyone what they do, and it's a great time to network, and they're just really high level people that attend. So I'm really glad we were able to meet.
Yeah. Well, I'm a little bit more focused. I am on the speaking circuit for the last 5, 6, 7 years, but these days I want to work through people in the know. You know your clients and what's going on, and if we can work with the developer or a small team on a real project, and then kind of look at it and drill down a little bit. And I'm not charging consulting fees for things like this. That's the nonprofit activities that we do. Just trying to get them to start on the path to carbon neutrality.
I love that. I'm going to keep that in mind because I want to think big, rather than one developer, unless it's a really big developer, something big. Yeah.
Yeah, we're usually working with multi-billion-dollar mixed-use developments. So, just one building or something like that. I don't think it's very impactful, especially here in Asia, when they say that we're building the entire GFA of London every month.
Wow.
Right? Not just for 1 month, but every month until 2030. It's mind-boggling. Anyway, thank you for your time, Anthony, and great to connect.
Yeah, thank you so much. We'll hopefully talk and connect again soon. Okay, bye-bye.